Every trader enters the market believing they're here to extract opportunity. But the truth is, the market doesn't give opportunity, it only reveals it. And it reveals it on its own terms, in its own time. The moment you forget that, you stop trading the market and begin trading your impulses. Most people think the danger in trading comes from volatility, sudden reversals, or the unknown. But the real danger lies much closer. The moment you decide you can get ahead of the signal. The moment you assume you know what the market should do. That single thought is enough to push you from a state of objectivity into a state of emotional distortion. When you act without confirmation, you are not trading a strategy. You are trading a fantasy. You are trying to make the market respond to your need for action, excitement, or certainty. And every time you do that, you reinforce a mental habit that strips away discipline and replaces it with randomness. Waiting for the signal is not about patience. It's about trusting your process over your impulses. It's a psychological commitment to consistency. The signal is your anchor. It is the point where your beliefs align with what the market is actually doing, not what you hope it might do. Impulse trades feel powerful in the moment, but they always leave you exposed. They erode confidence, destroy emotional balance, and chip away at your ability to think in probabilities. And thinking in probabilities is the foundation of all successful trading. So remember this. You don't wait for the signal because it guarantees a winning trade. You wait because it keeps you aligned with a mindset that allows you to win over time. Master the discipline of waiting. Let the market show its hand. Let your edge work the way it was designed to. Do that consistently, and you'll step into the rarest space in trading, the space where you no longer need to control the market because you finally learned to control yourself. Trading edge only matters when you allow the market to confirm it. That single principle sits at the heart of consistent profitability, yet it's one of the hardest truths for a trader to internalize. Most traders think the moment they identify an edge, the market should immediately respond to their expectation. They believe that spotting a pattern, reading a setup, or anticipating a move is enough to justify taking action. But the market is not obligated to validate your opinion, and it will not reward you simply because you've decided to participate. The edge is never the pattern you see or the indicator you trust. The real edge is your ability to wait until the market shows you that the opportunity you believe exists actually does exist. Without that confirmation, your so-called edge is nothing more than a guess dressed up as strategy. Traders who truly understand this principle treat confirmation not as an optional filter, but as the moment the trade becomes real. Before the signal appears, everything is potential, possibility, speculation, probability. Once the signal arrives, possibility transforms into alignment. It's the point at which your expectations and the market's behavior finally match. That moment of alignment is what gives your edge its power. Not the idea, not the pattern, not the hope, but the alignment itself. Without it, you're swinging in the dark, reacting to illusions created by your own impatience or need for action. The danger of ignoring confirmation is subtle at first. You get one or two impulsive trades that go your way, and a sense of confidence begins to grow. You start believing you can read the market without needing it to prove anything. You begin to trust your feelings over your rules. But the market is never interested in supporting your emotional impulses. It might reward you randomly at first. But that random reinforcement is a trap. It encourages behavior that is fundamentally destructive. When a trader wins on impulse, they internalize a belief that their instincts are superior to structure. They begin interpreting randomness as skill. They mistake luck for mastery. And once that belief takes root, discipline becomes harder and harder to recover. Waiting for confirmation is not just about protecting your capital. It's about protecting your psychological framework. Trading is a game of mental alignment. Your thoughts, your expectations, and your actions must stay consistent across hundreds of trades. If you allow yourself to take one trade without confirmation, you open the door to taking 10 more. And with each one, your connection to your edge weakens. Your trading becomes reactive instead of structured. You stop following probabilities and start chasing sensations. You stop responding to the market and start anticipating what you want to see. The trader who refuses to wait for confirmation is not actually trading the market. They are trading their beliefs about the market, beliefs that are shaped by fear, greed, boredom, or the desire to feel in control. The impulse to act prematurely comes from a deep emotional urge to avoid uncertainty. When you feel discomfort, your mind seeks resolution, and taking action feels like a way to relieve that tension. But action without edge is never a solution. It just replaces emotional discomfort with financial consequences. And eventually, those consequences reinforce even more fear, creating a cycle of emotional trading that is incredibly difficult to escape. Allowing the market to confirm your edge means accepting that you do not control the outcome. You control the process. You control when you participate. You control how you respond. But you do not control when the market decides to validate your setup. This realization is both humbling and liberating. Humbling because it forces you to acknowledge your limitations. Liberating because once you stop trying to predict the market and start letting the market show you what to do, the entire experience of trading becomes calmer, clearer, and more objective. There is a deeper psychological layer to waiting for confirmation. It requires surrender. Not weakness, but surrender. Letting go of the need to be right, letting go of the impulse to control every fluctuation, and letting go of the idea that opportunity exists simply because you want it to. Many traders resist this idea. They equate surrender with passivity. But in trading, surrender is power. It means putting your ego aside and aligning with the market instead of trying to impose your thoughts on it. When you commit to waiting for confirmation, something profound happens. You begin to see the market as it is, not as you fear it might become. You stop anticipating every move. You stop reacting emotionally to each candle, each tick, each headline. Instead, you observe. You wait. You let the market reveal its intentions. And in that waiting, you gain clarity. That clarity is what protects your capital, preserves your confidence, and builds consistency over time. Think about the difference between a trader who waits and a trader who jumps impulsively. The impulsive trader is constantly in a state of internal conflict. They worry whether they entered too early, whether the move is real, whether they misread the pattern. The uncertainty eats at them from the moment they take the trade. They watch the chart fluctuate and feel each tick as a personal attack or validation. Their emotional state swings with the market, and their decisions follow those emotional swings. The disciplined trader, on the other hand, is not emotionally entangled in every candle. They have already predetermined the conditions that must be present before they enter. They know exactly what confirmation looks like, and because they wait for it, they enter the trade with far more clarity. They don't need to hope the market will align with them. They have already waited until it did. That creates emotional neutrality, the state of mind from which all high-quality decisions are made. Confirmation is not a guarantee of success, and it never will be. But it dramatically increases the probability that your trade is aligned with the market's current rhythm and direction. More importantly, it reinforces the habit of disciplined execution. Trading is not about winning every trade. It's about creating a consistent mental environment where your edge has the space to play out over time. Every time you wait for confirmation, you strengthen that environment. Every time you don't, you weaken it. The true professional trader understands that the market is not a puzzle to be solved, it's a flow to be aligned with. And alignment only happens when you let the market lead. Your analysis may tell you what could happen, your experience may tell you what is likely, but only the market can tell you what is actually happening right now. Confirmation is the bridge between your expectation and reality. Without that bridge, you are trading on imagination. So when you face the temptation to enter early, remind yourself of this. Your edge only exists when the market validates it, not before. Not because you want it to. Not because the last 3 trades followed your prediction. The market does not bend to your will. Your job is not to predict it, but to synchronize with it. And that synchronization begins with something incredibly simple, profoundly powerful, and psychologically demanding, waiting for the signal. The trader who waits for confirmation is playing a different game from the trader who relies on impulse. One is operating with structure, discipline, and emotional clarity. The other is acting on hope, fear, and the illusion of control. Over time, the gap between those two approaches grows enormous. One leads to consistency, longevity, and confidence. The other leads to frustration, instability, and ultimately self-sabotage. Your trading edge is not the setup you use. It's your ability to act only when the market confirms that the setup is present. That is where professionalism begins. That is where emotional mastery begins. That is where long-term success begins. The market doesn't reward impatience, it rewards alignment. And the only way to align consistently is to wait, not passively, but with purpose, clarity, and unwavering respect for the process. Your edge matters only when the market says it matters. And that moment, when price, structure, and your rules come together in harmony, is worth waiting for every single time. Waiting for the signal is a commitment to discipline, consistency, and emotional neutrality. It is far more than a trading instruction. It is a psychological contract between you and the market, a vow that you will not act from impulse, fear, or hope, but from alignment with a predefined structure. The signal is not just a technical confirmation, it is the point at which you willingly surrender your emotional need for immediacy and instead choose to operate within the boundaries of a process. That single act, waiting, quietly separates the amateurs from the professionals, the emotionally reactive from the strategically prepared. Most traders misunderstand discipline. They think discipline means forcing themselves to sit still, fighting urges, or trying to suppress emotion through sheer willpower. But true discipline in trading is not a battle. It is a decision made long before you even open your platform. It is the firm psychological stance that you will only act when the market aligns with the criteria you defined, while clear-headed, objective, and rational. Discipline is not the absence of emotion. It is the ability to act independently of emotion. When you wait for the signal, you are proving that your decisions are not dictated by internal psychological fluctuations, but by external observable market conditions. Consistency is the natural extension of discipline. Without waiting for the signal, consistency is impossible. Every impulsive trade becomes an exception, and exceptions erode structure. If you take one entry without confirmation, you create a small crack in your rules. If you break the rule once, you will break it again. And soon your entire trading plan collapses into a pattern of random decisions driven by whatever emotion dominates you in the moment. But when you consistently wait for the signal, you reinforce a stable identity as a disciplined trader. You become predictable to yourself, an essential requirement for long-term success. You know how you will respond under stress because your rules dictate your behavior, not your emotions. Consistency gives your edge room to function. Without it, even the best strategy becomes worthless. Emotional neutrality is perhaps the most misunderstood component of trading psychology. Many traders think being emotionally neutral means feeling nothing. But that's not what neutrality means. Emotional neutrality is the ability to observe your emotions without acting on them. It is the ability to recognize desire, fear, excitement, or frustration, while still waiting for the market to provide confirmation. It is detachment, not from the market, but from your own internal noise. When you wait for the signal, you are not suppressing emotion. You are choosing not to let emotion dictate your actions. The signal becomes the anchor that stabilizes your mind, giving you a reference point that is outside your emotional experience. Waiting is psychologically difficult because it confronts the most primitive parts of your mind. Humans are wired for action, not patience. When you see price moving quickly, every instinct screams at you to get involved. Your mind creates stories. If I don't enter now, I'll miss the move. This is the moment. This is the opportunity. But opportunity in trading is not created by emotion. It is created by structure. The market is full of movement, but very little of that movement is meaningful without confirmation. When you act before the signal, you are responding not to the market, but to a projection of your own desires. The market doesn't reward desire, it rewards alignment. Waiting for the signal forces you to confront the fear of missing out. That fear is one of the most powerful forces in trading. It manifests as tension, impatience, and a sense of urgency. But urgency in trading is almost always an illusion. The market will provide endless opportunities. There is no single trade that will make your career, just as there is no single trade that will destroy it, unless you're acting without rules. When you wait for confirmation, you disrupt the cycle of urgency. You replace "I must get in now" with "I enter only when the market meets my criteria." You shift from reactive to selective, and that shift is transformative. The discipline to wait also neutralizes overconfidence. Many traders fall into the trap of believing they can anticipate the market. After a few wins, they start thinking the signal is merely a suggestion, something they can skip when they feel the direction is obvious. But markets are full of illusions. What looks obvious is rarely reliable. Overconfidence leads to premature entries, oversized positions, and a distorted perception of risk. Waiting for the signal forces you to acknowledge that your feelings about the market are irrelevant, unless confirmed by price action. This humility protects you from the emotional biases that lead to ruin. Consistency in waiting also protects your mental capital. Traders often focus only on financial capital, but mental capital is far more valuable. Every impulsive trade drains mental energy, creates emotional turbulence, and generates internal conflict. You start doubting your strategy, questioning your decisions, and blaming yourself. But when you enter only on confirmed signals, your mind remains clear. If the trade loses, you can accept it without emotional damage, because you know you acted according to your plan. You know the loss is part of the game, not the result of emotional error. This is emotional neutrality in action, accepting outcomes without attaching emotion to them. Waiting for the signal also transforms your relationship with uncertainty. Most traders fear uncertainty and try to eliminate it by acting quickly. But in trading, uncertainty cannot be eliminated. It can only be managed. The signal is your tool for managing that uncertainty. It gives you a point of reference that increases probability. Waiting for it does not eliminate risk, but it ensures you are entering with the highest possible alignment between your analysis and the actual behavior of the market. Once you understand that the only certainty in trading is the process, not the outcome, waiting becomes much easier. You no longer search for guarantees, you search for conformity to your rules. When you consistently wait for the signal, your entire trading identity changes. You become calm, selective, and intentional. You stop feeling pressure to catch every move. You stop chasing price. You stop responding emotionally to fluctuations. You develop a mindset where missing a move is not painful because you know the move wasn't yours. It wasn't confirmed. You learn to let the market go without you when it has not aligned with your plan. This is one of the most powerful psychological shifts a trader can make. Waiting for the signal also enhances your ability to execute trades flawlessly. When you enter early, you are often filled with doubt and second-guessing. You adjust stops prematurely, exit too early, or add to losing positions. But when you wait for confirmation, execution becomes mechanical. The decision is already made in advance, the signal simply triggers the action. This reduces cognitive load, minimizes internal conflict, and frees your mind to focus on managing the trade rather than questioning it. The long-term reward of waiting is not just better entries, it is better psychology. Over hundreds of trades, your habits shape your results. Every time you wait for confirmation, you reinforce patience, clarity, and confidence. Every time you act impulsively, you reinforce chaos, inconsistency, and emotional instability. The gap between these two paths widens dramatically over time. One leads to growth, the other to self-destruction. Waiting for the signal is more than a trading rule. It is a mindset. It is a declaration that you will not be ruled by impatience or fear. It is the embodiment of discipline, the foundation of consistency, and the essence of emotional neutrality. It is the quiet, steady commitment to let the market speak before you act. And in that commitment lies the difference between a trader who survives and thrives and one who burns out and disappears. When you wait for the signal, you are proving something important, not to the market, but to yourself, that you can choose structure over impulse, clarity over chaos, and mastery over emotion. Impulsive trades are the result of unexamined fear and hope. This truth sits at the core of trading psychology, yet most traders spend their entire careers avoiding it rather than confronting it. They blame the market, their indicators, the news, volatility, or even luck. But rarely do they look inward and ask the one question that truly matters: why did I act without thinking? Impulse is not randomness. It is the mind revealing its deepest emotional patterns in real time. And until those patterns are examined, understood, and neutralized, they will continue to dominate your trading decisions, no matter how sophisticated your strategy might seem. Fear and hope are the two emotional forces that shape almost every trading mistake. Fear pushes you into trades you should avoid. Hope keeps you in trades long after your rules tell you to exit. These emotions don't appear suddenly. They build from subtle beliefs about loss, opportunity, and certainty. When those beliefs go unexamined, they lead to impulsive decisions that feel justified in the moment, but reveal their destructiveness only after the trade is over. Fear is one of the primary drivers of impulsive trading, but it rarely presents itself as fear on the surface. It disguises itself as urgency, pressure, or a sudden intuition that something must be done immediately. It manifests as the fear of missing out when price begins to move without you. It shows up as the fear of being wrong, leading you to exit prematurely or reverse positions without logic. Fear even appears as the fear of feeling regret, which can push you into taking trades simply so you don't have to watch the market move without being in. All these forms of fear demand action, not patience. They demand movement, not clarity. And when fear demands action, the result is always impulse. The tragedy is that most traders don't recognize fear when it arises. They misinterpret it as opportunity. They see a fast-moving candle and think, "This is it, I must act now." But that thought is not analysis. It is emotion. Fear has convinced them that the present moment holds special meaning, that failing to act now will lead to loss or regret, yet the market is not offering them urgency, their mind is. The market doesn't care if they take part in the move. The market will continue without them. The urgency they feel is internal, not external. Until they realize this, they will continue to conflate emotional demand with trading opportunity, leading to impulsive entries that violate their own rules. Hope operates differently, but its effect is just as destructive. Hope is the emotional resistance to accepting reality. When a trade begins to move against a trader, hope whispers that the market will turn, that the setup is still valid, that the loss is temporary. Hope urges the trader to hold on just a little longer, to avoid the emotional sting of taking a loss. Hope convinces them to move their stop, widen their risk, or simply ignore their rules altogether. Yet hope is not analysis. Hope is a refusal to face the present moment as it is. When unexamined, it becomes a justification for reckless behavior. Hope shows itself in impulsive trades when traders enter positions without a signal because they want the market to do something. They want to catch the reversal early. They want to catch the breakout before it becomes obvious. They want to anticipate the move instead of waiting for confirmation. This desire is nothing more than hope masquerading as insight. The trader is not reading the market, they are projecting their desires onto it. And once again, impulse takes over. Both fear and hope stem from the same psychological root, the desire to avoid emotional discomfort. Fear wants to avoid the pain of missing out or being wrong. Hope wants to avoid the pain of losing or admitting that a trade is invalid. But trading requires the ability to accept discomfort without responding impulsively. Those who cannot tolerate discomfort will always act impulsively because their actions are attempts to escape emotion rather than follow logic. Impulse thrives in the absence of self-awareness. When a trader does not examine their beliefs, they default to emotional decision-making. Every chart becomes a battlefield for their unresolved fears and unfulfilled hopes. They don't see price action. They see threats and opportunities through the lens of emotion. They are not reacting to the market, they are reacting to internal pressures. Until those pressures are examined, trading becomes a cycle of emotional relief rather than a process of disciplined execution. Traders often believe their impulsive decisions come from intuition or experience, but intuition without mastery is just a guess disguised as confidence. True intuition in trading arises only after thousands of hours of structured practice and observation. Most traders mistake emotional impulse for intuition because it feels urgent, vivid, and compelling. But emotions often feel compelling. They are designed to be. Their intensity does not make them accurate. And trading on emotion, no matter how strong, is equivalent to gambling. To eliminate impulsive trades, one must first understand the emotional triggers behind them. This requires observation, honesty, and introspection. For example, does a fast move create anxiety? Does a string of losses generate the urge to make it back quickly? Does watching others profit in a move you missed make you feel inadequate or frustrated? These emotions create the conditions for impulsive entries. Recognizing them is the first step to disarming them. Once you understand the emotional triggers, you can begin to separate emotion from action. The goal is not to eliminate fear or hope. They are natural human emotions. The goal is to prevent them from dictating your behavior. When you become aware of your emotional state, you can consciously choose to wait for the signal rather than act from impulse. You can ask yourself, is this trade part of my plan, or am I trying to avoid a feeling? That simple question can break the cycle of emotional trading. Another powerful way to combat impulsive behavior is to create trading rules that explicitly define what qualifies as a valid entry. When you have a clear definition of a signal, you can measure every potential trade against that criteria. If it doesn't match, you don't act, no matter how strong the emotion feels. Over time, this builds discipline and reinforces the identity of a trader who follows process over emotion. Eventually, the habit of waiting becomes stronger than the impulse to act from fear or hope. It's also essential to understand that impulsive trades are the enemy of consistency. Every time you take an impulsive trade, you break the continuity of your system. You create confusion in your mind. You create doubt about whether your results reflect your edge or your emotional actions. Consistency cannot coexist with impulsiveness. If you want consistent results, your decisions must be consistent. And consistency is impossible when fear and hope are unexamined drivers of your behavior. Impulsive trades also erode confidence over time. After every impulsive decision, even if it wins, there's a subtle sense of internal conflict. A part of you knows you didn't follow your rules. A part of you knows the win wasn't earned. And when the impulsive trade loses, the emotional fallout is even worse. You feel regret, frustration, self-criticism. These emotions drain your mental energy and make future discipline harder. The cycle of impulsive trading feeds on itself. Impulse creates losses, losses create fear, fear creates more impulse. However, once you begin to examine the emotional roots of your behavior, a transformation occurs. You start recognizing that your impulses are not commands. They are signals from your mind that something inside you needs awareness. Instead of acting on fear or hope, you observe them. You begin to understand the difference between emotional urgency and genuine market opportunity. You develop patience and clarity. You start trusting your rules more than your emotions. And slowly, the need for impulsive action fades. In the end, impulsive trades are not a failure of skill. They are a failure of awareness. They reveal parts of yourself that have not yet been confronted. But when you bring awareness to fear and hope, when you examine the emotions behind your decisions, you gain power over them. You no longer trade to escape emotion. You trade to execute a process. And when trading becomes process-driven rather than emotion-driven, everything changes. Impulsive trades lose their grip. Fear loses its influence. Hope loses its distortion. What remains is clarity, discipline, and the ability to act only when the market truly aligns with your plan. This is the foundation of professional trading, not eliminating emotion but mastering it. In the end, impulsive trades aren't market mistakes, they're psychological ones. They arise from unexamined fear and hope, from the emotional urge to avoid discomfort rather than follow structure. When you learn to recognize those emotions instead of acting on them, you reclaim control over your decisions. Mastery comes not from predicting the market, but from mastering yourself. And when your actions are driven by awareness instead of impulse, discipline replaces chaos, clarity replaces noise, and your trading finally becomes consistent, intentional, and aligned with your true edge.